Thursday landed on the list of the best returns in the last 70 years. That 5.5 move on Thursday put it at 15th all time.
It was a big one, and I think the market really reacted to that inflation print. Inflation coming in softer than expected and continuing its downward trajectory. The market had been pricing in 50-50 odds that we would get either 50 or 75 basis points in hikes this December, but that softer print led to an 80% likelihood of only 50 basis points. Moreover, the terminal Fed funds rate is now down to a range of 475 to 500 basis points, down an entire hike from 500 to 525.
Right.
What I would stress is directionality is important here. This is the first time this year where a CPI report led the market to price in a more dovish Fed. The market is constantly pricing in new information, and if the economy softens or inflation continues to surprise to the downside, it's possible that December is the last hike.
Then we'll have to take a look because, of course, that 75 basis point hike that we did see in November was widely expected. And as Jason points out, Danny, we saw a 50 basis point. It seems to be the number. We'll have to see what happens into January. But, folks, this is all coming around the idea that the Federal Reserve is trying to dampen demand. I know that sounds counterintuitive, but that's exactly what they're doing. And by dampening demand, what they do is they raise interest rates, which slows down buying in certain industries, which you would think would hurt companies' profitability. So we're going to have to watch that. The market's reaction, however, was interesting because it wasn't just the Fed and perhaps a slowing of the Fed, but we watched the U.S. dollar.
Oh, yeah, we watched that very closely. And the dollar was down 3.5% between Thursday and Friday, a massive move, and it broke an uptrend formation that had been in place since January. And Dave, to your point, when we think about a strong dollar, what does that mean for earnings? It means weaker earnings on a go-forward basis for these multinational companies.
And let me just jump in, Jason, and have you explain why that is with the movement of the dollar, why that hurts profitability, especially of U.S. multinationals.
Absolutely. So if you are a company that has sales in Europe and they are selling at the general price level, they're effectively earning income in Europe. And when that income is then translated back into U.S. dollars, they're losing purchasing power. And as a result, the dollar-denominated returns enjoyed by shareholders is effectively lower.
Yeah, so we always watch the U.S. dollar, not only for that very reason, because a lot of S&P companies, for example, derive a large percentage of their revenue overseas. And of course, folks, commodities, most commodities in the world are priced in U.S. dollars. And of course, we all know what that means for energy prices because, of course, energy is a commodity. That is the reason why you need to go through your portfolio and make sure that your asset allocation is lined up with the realities of today.